I want to ask you a simple question. If you have invested 1 lakh rupees today, whether in a fixed deposit, gold, real estate, or mutual funds, how much money would you have after 20 years? I'm sure you have a rough idea, but knowing the actual numbers is extremely important. They might surprise you. Today, we will look at real data that proves why smart Indian investors are increasingly choosing mutual funds over the other conventional investment products. More importantly, we will understand why you should know this too. Why do mutual funds outperform almost every other investment options? So let's find out. The numbers don't lie. I'm sure you have heard this before. Let's see how the same investment can generate very different returns depending on where you invested. Rupees 1 lakh invested for 20 years. Fixed deposits at 6.5% interest post tax return, your 1 lakh become 3.52 lakhs in 20 years. Gold with an average CAGR of 8 to 9% return, 1 lakh become 4.66 lakh in 20 years. Real estate, interesting, averaging around 8 to 10% in tier 2 cities. Your 1 lakh investment become 6.73 lakhs. But your money remains logged in. Now let's see the stock market. The Nifty 50 index fund offers around 12% CAGR with relatively lower risk and no complicated investing. Simple index investing, passive investment. Your 1 lakh become 9.65 lakhs in 20 years. The investment amount is the same, period is same, yet the final outcome is almost 3 times higher. That's the proof. Now let's look at why mutual funds are preferred investment choice today. You can also think of these as the key features of mutual funds advantages and why mutual funds outperform all other asset classes mentioned here. Let's see. Advantage number 1, the power of compounding. Albert Einstein famously said, compound interest is the eighth wonder of the world. We'll see now and try to understand why it is so. Let's say if you invest 5,000 rupees every month through SIP for 20 years, assuming a 12% annual return, your investment grows to 49.96 lakhs, which is approximately 50 lakhs. So your total investment was 12 lakh in this example, and the wealth created is 37.96 lakhs. In other words, you invested 12 lakh and the mutual fund generated almost 38 lakhs of additional wealth for you in 20 years. That's the power of compounding. Profit is generated on profit. Also, not just on the invested capital. Every year's profits get added to the principal and become your total capital for the next year growth calculation, unlike other traditional investment products. Advantage number 2, professional management and diversification. You can't realistically research 5,000 listed companies in Indian bourses. Professional fund managers can. They have the infrastructure, they have dedicated research team, advanced tools, and years of market experience. Let's be honest, they understand the markets far better than most individual investors. Another major advantage is of diversification. A single mutual fund may invest in 50 to 100 different companies. Even if 2 or 3 companies perform poorly, your portfolio is unlikely to be significantly affected. When you invest directly in a handful of stocks, you are exposed to concentration risk. Similarly, if one real estate investment doesn't perform well, a large part of your wealth can remain stuck for years. Advantage number 3, liquidity. Liquidity matters. Selling a real estate property can take 6 months to a year. You will also have to deal with brokerage charges, stamp duty, and paperwork. With fixed deposits, withdrawing money before maturity usually attracts a penalty. Mutual funds, on the other hand, are much more liquid. In most cases, your money is credited in your bank account within T plus 2 working days, which is effectively 2 working days. And after the exit load period, there is generally no penalty for redemption. If an emergency arises, you can access your money in just a couple of days. It is very much liquid in that sense. Advantage number 4, start with just rupees 100. One of the biggest advantages of mutual fund is accessibility. You can start SIP with as little as 100 rupees per month in several mutual fund schemes. Compare with the real estate, where you need lakhs of rupees just to begin with. Mutual funds have truly democratized the wealth creation in India, making investing accessible to almost everyone. Ironically, many of us do not invest our surpluses just because the investment capital is too low at the end of the month. I experienced that too in my initial days. If I had rupees 2000 left at end of the month, I did not invest that amount thinking it is too small amount to invest. But in mutual fund, it's really made the choice very simple here. You can invest any amount. Advantage, tax efficiency. Taxation also makes a significant difference. Interest earned on fixed deposits is taxed according to your income tax slab. If you are in 30% tax bracket, you lose 30% of your interest income to taxes. For equity mutual fund, in the other hand, held for more than 1 year, long-term capital gain are taxed at only 12.5% on gains exceeding 1.25 lakh that particular year. If your profit for the year is less than 1.25 lakh, there is no tax. And your profit is taxable only when you withdraw it. Debt mutual funds follow different tax rules. For, with short-term gains taxed at a slab rate and the long-term gains taxed according to the applicable provision. Compared to fixed deposits, mutual fund can often be a far more tax efficient investment option for long-term wealth creation. So, there you have it, the proof. We talked about the various advantages of, mutual funds over the other investment products in India. There are 5 solid reasons why mutual funds have become one of the India's most preferred investment options. If I have to paraphrase what we already discussed, the advantages exponentially. Professional management and instant diversification reduce your investment risk. High liquidity ensures you can access your money whenever you need it. And you can start with as little as 100 rupees, making investment accessible to all our fellow Indians. And of course, mutual fund is tax efficient, makes mutual fund a smarter choice for long-term investors. Well, if you are still keeping all your savings only in fixed deposits, then this series is made specially for you. Let us know in the comment, where do you currently invest your money? Fixed deposits, gold, or mutual funds? Now, time for disclaimer. This video is strictly for educational purposes and should not be considered as investment advice or recommendation to invest in any financial product. We are not just building wealth, we are building the right investment mindset here. So don't forget to subscribe. And thanks for watching.